In the first quarter of 2026, the traditional metrics used to measure the health of China's automotive market broke down. Three distinct trends define this transition: volume-price structural divergence, the 50% penetration tipping point, and profit chain migration. Domestic retail volume dropped by 15% year-over-year, falling to 1.64 million units in March. Yet wholesale volume stabilized, with only a 1.6% decline, while exports surged by 74.3%. When retail volume crashes while factory output holds steady, domestic sales figures lose their utility as markers of industry health. This chart tracks China's auto industry profit margins. The line falls past the 5.8% industrial average red line, hitting a critical 2.9% floor. Total profits dropped 30% to 43.5 billion RMB. Production remains at record levels, but those units no longer guarantee capital return. External macroeconomic shocks have forced this compression. Global AI hardware demands drove up the cost of memory and compute components, while geopolitical constraints spiked energy and material costs. These rigid manufacturing costs have erased the financial buffer automakers previously used to absorb domestic retail discounts. The strategy of trading price for volume has hit its mathematical limit. Further cuts to sticker prices will trigger immediate cash flow exhaustion. Survival now depends on migrating to new profit pools. The market is shifting from a homogeneous domestic price war to a structural value war. Despite the 15% drop in volume and aggressive price wars, the market's average selling price climbed by 7,000 RMB year-over-year to 175,000 RMB. This waterfall chart shows total market volume stacked by price tiers. The rising average price is driven by the denominator effect. Wholesale volume for micro-electric vehicles dropped by 52%. When this massive low-cost volume is stripped away, the median price line is mechanically forced upward. Rigid battery costs and the expiration of tax exemptions destroyed the margins on entry-level vehicles. The razor-thin pricing on models like the BYD Seagull shows the economic pressure on this segment. Above the entry level, prices fracture by energy type. Traditional internal combustion engine vehicles retreat into premium niches, with an average price of 181,000 RMB. Extended range electric vehicles, or EREVs, command the highest average price at 234,000 RMB, capturing demand from high-income family users. Meanwhile, plug-in hybrid electric vehicles average 183,000 RMB. They are systematically draining the B and C segment value pools that once belonged to legacy automakers. The rising average selling price is a symptom of the lowest margin tier collapsing under its own economic weight. It has not regained pricing power. This gauge chart shows new energy vehicle retail penetration. In March 2026, it crossed the 50% threshold, hitting 51.5%. Breaking this down by brand origin reveals two realities. Autonomous Chinese brands operate at a 73.5% NEV penetration rate. Foreign joint ventures sit at 6.2%. Crossing the 50% threshold marks a trigger point for an impending financial write-down of legacy foreign auto manufacturing assets. With domestic margins evaporating rapidly, the primary structural mechanism keeping the Chinese automotive industry viable is overseas exports. The 13.4 percentage point gap between domestic wholesale and retail volume is excess factory capacity successfully absorbed by foreign markets. In March, the industry exported 695,000 units, a 74.3% year-over-year increase. This map highlights top export destinations: Russia, UAE, Brazil, the UK, and Italy. New energy vehicle exports jumped 139.9%, exceeding half of all exports. Export average selling price remains stable at $17,000. This points to a consistent value proposition, not low price dumping. To bypass increasing tariffs and trade barriers, companies are adopting capacity outbound strategies, establishing localized assembly plants overseas. Top players like BYD and Chery are now prioritizing localized assembly plants, exporting the manufacturing process alongside the vehicle itself. Profit margins in overseas markets are currently 1.5 to 2 times higher than in the domestic arena. Exports are the fundamental structural hedge, allowing OEMs to generate the cash flow required to survive the domestic pricing collapse. Institutional capital is flowing upstream, moving away from the 2.9% margin environment of the downstream vehicle integrators. it is moving toward Tier 0.5 suppliers, upstream technology entities that control the foundational architectures for smart vehicles, wire-controlled chassis, and robotic systems. This diagram maps the value chain. As retail automakers lose pricing power, these Tier 0.5 entities are capturing the economic value of the EV transition. Tier 0.5 suppliers achieve this through high-barrier technical monopolies. This depth prevents them from being commoditized in downstream price wars. Historically, economic value accrued to the brand badge on the hood. Today, it accrues to the globalized supply chain beneath the chassis. Vehicle integrators who remain trapped in domestic price wars face increasing cash flow exhaustion. The industry has transitioned away from a period of broad volume expansion. Companies can no longer rely on general sector growth to sustain operations. Industry power is now defined by two metrics: ownership of upstream Tier 0.5 technological monopolies and the global diversity of the profit pool.